morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me today, Jeremy Rettich with Virtue Capital over in Brentwood, Tennessee. Jeremy, I've known for, about 20 years, 15 to 20 years anyway, and love the family, love the business that they've got going for themselves. Jeremy's got some great strategies, which we've been sharing. We've been working together on how to improve, basically, our offerings for our clients. And this is one of the areas on the model portfolios I've been using for many years now, is seeing the value of adding in this equal weight index, as well as concerns about inflation and how to adjust for that and how to increase the benefit or the holdings there. So for instance, a Treasury Inflation Protected Security TIPS fund also. So we're always looking to improve upon what we have. If there's new information that becomes available, new research that becomes available, and we see the value in that to helping us, again, with what are our goals? We want to be able to get that market risk, the needed rate of return to accomplish our financial goals, while at the same time minimizing risk and volatility. It's going to make it easier. Jeremy touched on the average investor. Dow Bar is an independent research group, and they do a lot of research around individual investors and how the average investor does. And this is where they underperform the market typically substantially, like maybe 1/3 of what the market return might otherwise be if they would just stay invested, apply these buy and hold strategies that we talk about, and as well as some of the other strategies we're sharing, ways to even improve upon that further to where you can at least get that market return and do so safely. In other words, do so with minimal risk. The volatility is what creates a lot of problems for that individual investor, right? For when we're in there invested, it's one thing when you're thinking if the market went down 10%, I would behave in a certain way. It's another thing entirely when you get a return and you've lost 10, 20, 30%. Imagine a year ago, right? February to March, if you had $1 million in your portfolio and it turned into $700,000 in less than or in approximately a month, I think it was 22 trading days, right? Think about that. Would you in fact stay invested? You may have been so stunned it happened so quickly you may not have had a chance to react. But it was in seriousness. I had a lot of clients that would call and they just wanted to make sure, is this still, are we okay? And of course, this is where the asset allocation modeling comes in and the discipline. And that's my job, is to help you stay disciplined and follow that strategy. But to do that, and this is one with my clients, that's easy because I know they're invested properly. I don't know your portfolio necessarily. I don't know if you're invested properly to where it is the wise thing to do. Mutual fund companies go out of business. Stocks, companies go out of business or file bankruptcy. Think of General Motors as an example, and how the stockholders prior to that bankruptcy were holding, had that money invested. After bankruptcy, they lost all that money. And now we have new stockholders in jail. We don't want you to be one that is going to be at that kind of risk. So this is why in sharing these strategies, I also say to you, if you want to get a personalized plan, okay, not just the general things that we have to deal with when we're in this medium. But if you'd like to get a personalized plan, call my office, 615-376-5325. We'll do up a comprehensive financial plan for you. Includes an investment analysis. We'll pull Morningstar reports. As Jeremy, term that Jeremy uses that I love is a stress test. We're going to do a stress test of your portfolio. How would it do in a bear market? How much might it lose? More than the market? As much as the market? And how can we minimize that risk? Part of this planning also is I'll show you your financial future based on the things you're doing. And then I'll share strategies with you on how you can improve that future to make sure you're able to attain and maintain your standard of living, your quality of life, no matter how long you live, to be able to have fun in retirement, to be able to thrive in retirement, not just survive. All right, fund money is a big part of it. There's a lot that goes into all the different pieces we cover in the planning. If you'd like to take advantage, there's the number, 615-376-5325. When you call in, we'll get your information, send you out a checklist of things to bring to your appointment for us to do this planning for you. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, well, we were talking about equal weight index. This is one of the other areas versus market weight index. One of the things there, Jeremy, has to do with first it was the part about the different companies. So we're talking about the size of companies as an example, market capitalization. But then there's a whole nother part to the market, and that's about sectors. So on the sectors, we have different weighting and what effect that has in terms of the market sectors. So let's take a look at that spreadsheet. There we go. So on this one, Jeremy, why don't you, I mean, here you see this heavy weighting in just a couple of sectors.
Yeah, Hank, you'll see in the top 3 sectors there: consumer discretionary, industrials, and information technology. So technology represents about 43.5% of all 11 sectors. So that is the market weighting, right? Not equal weight, that's the market weighting. And when you look at the difference of equal weight versus market weight, it is the ownership of the companies, right? Equal weight, you have the same exact ownership of every single company from the largest to the smallest. Market weight is the opposite. The size of the company, take Apple for example, you'd own about 6% of Apple, about 5.5% of Microsoft. Top 5 represent over 20%, as we talked about. It's the same thing for sectors. So as you can see here, there's 11 sectors in the S&P 500, and some of those sectors have a much larger weighting for market cap. I talked about earlier about the NASDAQ only being up 2% and being a lagger this year. When you look at technology, year to date through last Friday, it was up 4.1%. So out of 11 sectors, it was number 4. There were other sectors like energy that was up 34%, financials up 17.5%. So it does matter from the companies you hold, but also the sectors and the weighting that they're in. Equal weight has more of an equal weighting. You look at it, 10% less ownership in technology and equal weight than there is in market weight. But I want to stress, to your point earlier, Hank, it's not one against the other, because as I said, equal weight and market weight have changed leadership 7 times since inception. But if you're only invested in the traditional S&P 500, or that's one of your allocations that you have, and you don't have anything to equal weight, it's something to consider, and most don't know about it because of how long it's been around, is less than 20 years now. So a lot of people don't know about it. And just one other point on how few advisors and investors know about it: equal weight, the few ETFs that are out there collectively represent about $35 billion. And then you look at market weight, just 2 of those represent about $340 billion.
And it shows how, when you look at the S&P 500 index over the last 10 years, it's well outperformed. I mean, you're talking about, I think it's about an average of 13% a year for a 10-year period. Actually 11 years. It's even with the little blip last year with the very fast drop for 34% and then complete rebound, and I think we ended up around 20% on the year. Pretty phenomenal when you think of the last 2 years, 2019 and 2020. I think it's been, the S&P is up somewhere around 50%. Pretty amazing. All right, but now here's the other piece of that. Think in terms of how that big run, what does that mean going forward? And one of them, Jeremy, you talked about is NASDAQ. So this next slide, in fact, talks about the QQQ, this Invesco fund that makes up the NASDAQ 100. And I think you had some stats that said something with regard to year to date. Now, so as well as NASDAQ has done, and it was last year as an example, had a phenomenal year. But now all of a sudden in this first quarter, we're seeing maybe a little bit of a change there.
Yeah, and NASDAQ had a fantastic year last year, and those that were invested, or wholly or hopefully not wholly, but partially, saw a great return. This year, it's been much smaller. The NASDAQ, as I mentioned, for the whole first quarter was only up about 2%, versus the S&P was up about 6, just under 6, and the Dow was up almost 8%. So it lagged significantly. So that goes to talk about rebalancing, and rebalancing can be where it's done mechanically on its own, like an equal weight or your portfolio. Hank, I know you do that quarterly for your strategies that you have, but it can also mean, hey, let's look at my portfolio. Do I have too much weighting in any one sector or any one stock? Do I need to trim some of that and rebalance, if you will, into other opportunities to hopefully, like the equal weight, 98% of the reason it's outperformed the market weight is rebalancing. So maybe your portfolio needs needs to be rebalanced, or in the environment we're in, reallocated and rebalanced.
This is the question, you know, does your current advisor do that for you? Do you know if your portfolio is rebalanced on a quarterly basis, on a regular basis, to make sure you're capturing more return and that you're also minimizing risk at the same time? And here's another strategy we're going to share with you, and this is one that I really like as well. And in fact, on the model portfolios that I use with my clients and that I invest in personally, this is one of the strategies that we're also employing from Virtue that has to do with the stop loss. So Marilena, this one, if we go forward, the stop loss and market buyback features of that slide. And this one, Jeremy, you talked about briefly with regard to the stop loss. And yes, on the portfolios, what I've done is I've got, on the model portfolios I use, we've added the stop loss as an option. So in other words, you can go with the buy and hold strategy still that we've used for many, many years. Or if you would like a little insurance, if you'd like a little more peace of mind, if you'd like to have this stop loss overlay, this stop loss strategy applied, you can still invest in those same portfolios, and there's a small added cost with that. It's just like buying insurance, right? But it would protect you in particular in a major downturn. And Jeremy, on this one, on the stop loss, as you said, it did phenomenally well last year. And even when you look at it over the last few bear markets, this is a way that you can at least protect yourself against a really bad drop in the market.
Yeah, Hank, that's right. And there's no perfect investment, right? There's not. And that's why asset allocation and diversification is key, right? I mean, it really is. Because there's going to be times, I talked about S&P market weight versus equal weight. They've changed leadership 7 times. I'd rather own both than one or the other. And when you talk about the stop loss, just at a high level, we've got a report, that 14-page report that does a much deeper dive into stop loss methodology if you have interest. We'll put that number back up here in a few. But looking at the chart, just talking at a high level, how does the stop loss work? Because it is mechanical on the selling trigger and the buyback features. So when the S&P 500, not your account, not equal weight, when the S&P 500 closes down from its most recent all-time high, 12% or greater, we go defensive, if you will. We sell out of equities, whether it's equal weight or market weight or QQQ, or Hank, in your example, the equities in your portfolios. We sell that equity risk. Why do we do it at 12%? There's a 5% decline typically every 3.3 months. There is a 10% decline typically every 14 months or so. And looking at a 12% decline, as I touched on earlier, history shows us much higher probability of a further decline. So again, we sell out of equities and we go into fixed income and we wait until there is somewhat of a recovery. And there's 2 different triggers to buy back. One is much quicker if the S&P, when it hits a bottom, is below a 30% decline, because history has shown when we go down 30%, when we hit a bottom and come back up, it's much quicker. The other trigger that we see more often is when there's between a 12 and a 30% decline. And we have a hard number on return. When 50% of the price return of the S&P has recovered, we buy back in. And again, Hank, history, when we look at it, you know, as Mark Twain says, it doesn't repeat itself, but it often rhymes. So we're looking at a long period of time in data when we built these models.
There you go. So it's about statistical probability. When you're investing in the stock market, as you know, there's no guarantees there. Now, we do know that if you're invested properly, if you're following the rules that we talk about with the principles of asset allocation and diversification, that you're going to be fine. And the market does go up over time. We expect that you're going to see returns there. Now we're going to look to do more. We're going to look, how can we minimize that risk, minimize that volatility while still getting that market return? Stop loss could be one way to do that. In particular, if you're particularly risk averse when it comes to the stock market, this may be a way to give you a little more comfort. And as Jeremy was saying, it's when the S&P drops 12%. Typically, a moderate portfolio is only going to be down about half that. So this is a great way to help minimize risk. And we're going to talk about some other ways this could be used to your advantage as well, with regard to the equity component of your portfolio. But first, we're going to take a break. Join us here. We'll be right back on the Retirement Report.